recently, like Quant or QNT, performing exceptionally strongly in comparison to the backdrop of the wider crypto space, many people are turning and asking the question, are the bottoms already in for the likes of Bitcoin and the remainder of the crypto markets? And are we actually looking to enter into a bull market scenario sooner than anticipated? I'm going to spend the first section of this video just talking about this from my perspective, from a macroeconomic perspective, as well as potentially what we could see play out as we draw conclusions and comparisons from equities and one of the main governing factors for those. Looking at some information here at the moment, immediately we can see different statements like this being said: bearish sentiment and anticipation of a bottom. Well-known cryptocurrency market analyst Into the Cryptoverse, which I'm sure many of you are familiar with, surveyed more than 700,000 of his followers. You see there just over 11,000 responses, asking how do you feel going into Q4 for Bitcoin? And obviously responses either being bullish or bearish, majority 57% saying bearish. Such results come despite the fact that more and more technical and on-chain indicators suggest the bottom is near or has already been reached. Now, I'm not really interested in technical or on-chain indicators per se, but from a macro perspective and sentiment perspective, this is quite an interesting poll. You see this typically quite a lot leading up to the bottom of a particular market during a cycle, where actually the spread or the gap between bullish and bearish sentiment actually tends to widen, and you get an awful lot more people being bearish because they've been, trying to catch a falling knife, for example, as the markets have drawn down over a period of time. And ironically, when that spread appears to get at its widest channel, that is when the bottom has actually been in, and you see a reversal quite quickly. Now we're going to jump into some other macro economic indicators in a second as well, which may be looking at why this sentiment analysis could be true, and potentially we could see a bottom for Bitcoin towards the end of this year / early next year, with the potential then for the latter quarters of 2023 to be a bullish one. We can also see as well Rex Capital publishing data on the duration of historical bear markets. So if we're looking again at technical indicators for Bitcoin, we can see the days from peak to bottom have actually been shortening from 413 down to the most recent 21 to 22 period of 333 days so far, of 74% down from the all-time high. So potentially if we get to that 80% level down from all-time high, that could signal that we've actually hit the bottom of this particular, or for this particular cryptocurrency. That's also worth saying as well, whenever these bottoms have been hit, that doesn't mean things rocket immediately back up. That just means the lowest price has effectively been in, and we will begin our slow ascent back into a bullish channel. Anyway, enough looking at sort of cryptocurrencies per se at the moment. Wanted to look at some macro stuff, like I said. And one of these things, or one of these indicators, again, this sort of lies on the technical side, but has a lot of sort of macro knowledge steeped within, is the S&P 500 excess Cape yield. And this is based on the Shiller-Cape ratio, which looks at the cyclically adjusted price to earnings ratio for this case, this index is the S&P 500. And the ratio is calculated by dividing a company's stock price by the average of a company's earnings for the last 10 years, adjusted for inflation. Many of you will be wondering why the hell I'm talking about this. And this is because, of course, there is an incredibly strong correlation between equities in the US and the wider equity markets and the cryptocurrency markets. They generally move in tandem. And of course, that is all being governed by the monetary policy that we're currently seeing unfold at the moment. Anyway, the excess Cape yield is effectively the inverse of that Cape measure minus the US 10-year bond real yield, which of course is effectively a proxy for a risk-free rate. When the stock price gets too high, return from stocks tends to be lower than return from bonds for the next 10 years. When ECY gets low, stocks might start to decline, as seen in 2008 and 2018. So this is where we're going to focus more on. We can see here the blue line, which is this particular measure, spikes massively. Then we begin to see a very large drawdown around 2008, which of course was the financial crash. We can see that being replicated again in 2020, which was due to the pandemic. And at the moment now, we can actually see this excess Cape yield, or ECY figure, bottoming out around 2.5%, which, if you take into perspective of the median cases of 3.47 and a 70th percentile for 6.1%, we can actually begin to see that majority of the equities in the US, particularly obviously within the S&P 500, are actually undervalued significantly based upon this metric. Now, if these are undervalued, why are we still in this bearish trend that we're currently stuck within? Again, many of you should be familiar with the idea of interest rates and how they are being used as a tool at the moment to curb inflation. I speak about them an awful lot. And part of my thinking here, and many other types of economists and analysts are looking at, are the implied 3-month or 3-month Fed funds rates looking out into the future. Now, I recently responded to something on Twitter, which some people may have seen, but effectively a lot of the calculations and sort of sentiment towards the markets at the moment is actually being derived from this implied rate. They want to know what the terminal interest rate is going to be stretching out into the future, and when potentially we can start to see those interest rates fall, and then they will begin to take advantage of these other metrics like excess CAPE yield in order to buy back into these positions, i.e. signaling a reversal of markets from this incredibly bearish sentiment and risk-off environment back into a bullish risk-on one. What we can see here is the terminal rate from the implied 3-month Fed funds rate is looking to be somewhere in the realms of March. And we can see at the moment that is looking to be just shy of 5.2%. Fair enough. At the moment, we are just north of 3% and are currently on track to reach that 5.2%, providing the inflationary data and the economic data coming out of the United States doesn't change drastically from what the Fed are currently expecting. And what we can see here is we have 2 more meetings left in November and December. And then if we sort of extrapolate from what happened this year, we will have another meeting in January ahead of that March meeting, again extrapolating in 2023. So potentially 3 more hikes to take place over the next period until we reach March of next year. Now, from that implied rate and where we are today, that is a 1.95% difference in interest rates. And then over these 3 next announcements, then we could see 2 more rate hikes, of 0.75% or 75 basis points. That would be the 1.5%, and then potentially another 0.5 or 0.45% increase or 45 basis point increase to achieve that 5.2% terminal rate, to when we'll then begin to see things tailor off. So at the moment, things are looking likely that potentially the bottom for a lot of these markets could occur at the end of 2022, providing the economic data that gets released from the United States does not deviate from the current plan that the Fed has set out and the Federal Open Market Committee are looking at ahead of these meetings or during these meetings for their hawkish monetary policy. Hopefully this has made some sense. Too long didn't read is potentially, if things play out the way the Federal Reserve are intending, we could be seeing a bottom for some of these markets around the end of this year or very early next year. I don't think we're quite there yet. There may still be some more volatility and way to fall until we reach the end of the year. And that's my 2 pence worth on it. Anyway, let's jump into some actual crypto stuff now. Not saying that wasn't, but hopefully that, guys, gives you a bit more perspective on what my thoughts are on where the bottom potentially is. Worldwide Google searches for QNT or Quant are also up 92% of what it was at the all-time high prices back in 2021. And of course, this is off the back of Quant recently going on a major run. In fact, I'll pull that up for you really quickly. So as we can see here on the weekly, we're up 17%, and on the month, nearly 80%, with Quant surging back to nearly $190 a token. As I told you guys before, I'd been talking an awful lot about Quant when it was back in my buying region of around $100 a token, if not slightly less. Of course, people are still calling for this to come back down to sort of $40 or $50 ranges. I don't personally see us actually falling back down that far, considering the amount of noise that this is generating at the moment. However, of course, what must go up must come back down eventually, so we will probably see a bit of a pullback soon. So if you're looking to build a position in Quant, I'd probably say give it a couple of weeks, if not months, and look for any discounts as to when that arises. There are plenty of other cryptocurrency projects at the moment, for example, HBAR, XRP, XLM, etc., that are at massive discounts in comparison to their true value, which of course should be realized in the future as things continue to grow. Now, what is driving a lot of the noise at the moment with the price appreciation of the Quant token? Well, it's things like the CEO of Quant saying everyone at Swift is having interoperability issues and they want to go into production as soon as possible. And of course, there are rumors as well going around that Quant has in some shape or form partnered with SWIFT, which would then mean the over-ledger solution being used by nearly 11,000 banks. Now, I actually haven't been able to verify this at all, so I actually believe that this is a bit of a rumor at the moment. Apparently, SWIFT have been doing 3 separate trials using different forms of interoperability solutions for their different central banks and banking system message infrastructure. I believe Quant to be one of those. Chainlink is another interoperability solution, and they were probably using another one for their 3rd trial as well. But there's been nothing conclusive at the moment that Quant has actually been integrated or being used as an interoperability solution for SWIFT. This is all just rumors, and potentially this could be one of the ones that's driving the price. In fact, if I scroll down, you can see stuff like this: SWIFT partnering with Chainlink for cross-chain crypto transfer projects. Regardless, I'm still incredibly bullish on both of these, Chainlink and Quant, as an interoperability solution for the future. And of course, they both will do incredibly well in my opinion, and that's why I have them in my portfolio. Jumping across then and looking at HEDERA, some interesting stuff happening at the moment over in the NFT scene. 𝗟𝗜𝗡𝗦𝗧𝗔𝗠𝗦 has actually gone live for their whitelist mint, and we're looking now to see what the public mint date is. However, they're turning this into a bit of a game, it seems, with different teaser trailers, etc. being released. I'd urge you all to keep an eye on their Twitter and Discord socials to sort of be first announced from when the information goes live effectively for the public mint. Some cool stuff like this.
We don't give a freaking boon what the president thinks. So we've decided to leak the documents soon. They have the public mint date.
So as you can see by that teaser trailer there, apparently the documents are going to be leaked for the public mint date. At the moment, no one actually knows within the community, so obviously I can't provide the information to you guys. Like I said, keep up to date on their Twitter and socials. I'll also retweet any information that I do see for any of you that are interested in HEDERA NFTs and potentially Hungry Baboons, which of course at the moment is shaping up to be a very coveted project from across the space. Not only that, some more HBAR Foundation news as well. Leveraging at HEDERA, users can now mint carbon emission tokens natively on Avery Dennison's platform, with the ability to even offset footprint with carbon reduction tokens. Thanks for the HBAR ecosystem coverage, Sustain Brands. So we can see here as well now Avery Dennison getting even more interconnected with the HEDERA ecosystem. This just goes off the back as well, what I spoke about in the previous video with that AD topic name, looking like Avery Dennison is already processing transactions on the mainnet, and potentially that will begin to ramp up at speed over the next coming weeks and months, particularly when you're starting to see things like users being able to mint carbon emission tokens natively on the Avery Dennison platform. Great use case, and hopefully this will continue to drive the transactions on HEDERA, particularly as it goes hand in hand with what will be happening for native staking. Here's another update as well from STADER Labs, particularly because we are now approaching native staking, or it at least feels that way across on HEDERA. Dear HBARBarians, the new and reloaded HBARX v3 is live, along with growing DeFi on HEDERA and securing the network. Here is what it can do for you. So number one being HBARX can earn higher yields. With HBARX v3, you will get easy, reliable and low risk gains, along with the ability for flexibility. So HBARX will give you sweet DeFi opportunities on top of your staking rewards. Of course, this shouldn't come as a surprise to any of you. I've spoken about this in depth with not only in interviews with the STADER team on the channel, but also in some of my own videos. Here's the secret sauce. Your tokens, of course, are liquid. They're not locked while you're staking. This way, HEDERA's DeFi ecosystem and your gains are always growing. Not only that, auto compounding. All your staking rewards are auto compounded too. That means more yield with no extra investment at all. Plus, you save the time and money on fees. Now, what about HEDERA? So decentralization booster. This may be one of the reasons many people decide to use or continue to use the HBARX liquid token instead of the in-wallet staking features is, for example, because of this. By staking at STADER, you're helping to boost decentralization, and even more, STADER will be spreading the tokens to multiple different nodes, i.e. I had a question on this, can you stake a wallet to multiple nodes? You cannot. You can only stake to a single node, and your balance will be rolled up into that. Conversely, STADER will be spreading the tokens across to multiple different nodes, I guess for sort of redundancy purposes, and also helps to grow HEDERA's decentralization, as well as creating a more transparent network for us all. So if you wanted to stake to multiple different nodes, you'd either have to use the in-wallet staking features across multiple different wallets, or of course you could use the STADER account. Not only that as well, don't forget the in-wallet staking will also compound. Any balance, HBAR balance within your wallet will automatically get staked back to that node if you've enabled it. The same being said here for the HBARX token. The difference being the HBARX token, you can go and provide liquidity, say on SuperSwap Labs, get some additional yield from providing liquidity with the HBARX token. Of course, that is being then natively staked, similar to how the yield is working at the moment. And you're effectively getting a double up on your return for doing so. So of course, there will still be uses for HBARX depending on your appetite within DeFi. If you want to transition across to native staking, you can do so. Don't forget, I've got several different videos on my channel showing you guys how to take advantage of that. And also the latest video is talking about how close we potentially are to native staking actually going live on HEDERA. Anyway, I'm going to wrap up this video here before it gets any longer. Hopefully the beginning of it gave you a bit more of an understanding from my perspective as to where I think we are with the crypto markets at the moment. I am continuing to average into these positions, particularly things like HBAR. It still is nowhere near its prime time yet, and its utility is definitely undervalued in my personal opinion, and I will continue building that position throughout the rest of Q4 and into early Q1 next year, and probably for the foreseeable future until we start to see some really big price movements for the HBAR token, which of course many of us are looking forward to. If you did enjoy though, make sure you leave a like, drop a comment if you've got something to say. I do try and respond to as many of them as I possibly can. And of course, you could always find me over on Twitter sharing some different information. Until then, cheers.